Good evening. I have already covered long straddle and short straddle strategies in options. Now I am going to cover next strategy, which is called long strangle. This is also option strategy. So let's try to understand what is strangle. So a strangle is an option strategy where the investor hold position in both call and put options with different strike price. But please remember, in strangle, call and put strikes are different, but in straddle, call and put strikes are same, but the expiry same expiry and the underlying asset are same and expiry date are same. Strangle is a good strategy, is a good strategy if you think the underlying security will experience a large price movement in near future but are unsure the direction. However, this is a profitable mainly if the asset does swing sharply in price. A strangle is similar to a straddle but use options at different strike prices, where straddle use call and put at the same strike prices. Let's understand the major outcome. A straddle is a popular option strategy that involves holding both call and put on the same underlying asset. Straddle covers investors who think an asset will move dramatically but unsure of direction. A straddle is profitable only if the underlying asset does not swing sharply in price. The swing is sharp in price. You see the strangle. I will show you the different diagrams. See profit loss and the movement you see. Long strangle. So if movement in both direction, so you see the profit. This is another diagram. Long strangle. Characteristic unlimited profit, net debit, buy out the money call options and buy out one money put options. So this is the strategy application. The investor think the underlying asset or index will experience very high levels of volatility in near term. Risk limited to initial premium, reward unlimited, break even upper break even point is a strike price of long call plus net premium paid. Lower break even point is strike price of long put minus net premium paid. Strangle to make money, it would require greater movement on the upside or downside for the stock index than it would be for a straddle. This please have a note of this. It's how strangle work. In long strangle, more common strategy, the investor simultaneously buy out of money call and out of money put options. The call option strike price is higher than the underlying asset current market price, while the put has a strike price that is lower than the asset market price. This strategy has a large profit potential since the call option has theoretically unlimited upside if the underlying asset rises in price, while put option can profit if underlying asset falls. The risk on the trade is limited to the premium paid for two options. An investor doing short strangles similarly to sell out the money put and out the money call. This approach is neutral strategy with limited profit potential. A short residual profit when the price of underlying stock trades in narrow range between the break-even points. The maximum profit is equivalent to net premium received for writing the two options less trading costs. So let's go ahead the example of this. Let's say XYZ firm is trading 50 rupees per share. To imply the Strangle strategy, a trader enter into option position, one call, one put. The call has a stock price 52 and the premium is 3 rupees. For the total cost is 3 into 100 share is 300 rupees. The put has a strike of 48 rupees and the premium 2.85. The total cost is 285 rupees. Both options have same expiry date. If the prices of the stock stays between 48 and 52 over the life of a spawn, the trader loss will be 585 rupees, which is total cost of the put option. The two options contract 300 plus 285 rupees. However, let's say the XYZ firm stock experiences some volatility. If the price shares and at rupees 40, the call option will expire worthless and the loss will be 300 rupees for the option. However, the put option has gained and produce a profit of 715 rupees, rupees 1000 less than the uh, option cost of rupees 285 for the options. Therefore, the total gain for trader is 415 rupees, rupees 715 minus rupees 300 loss put option. If the price rises to 55, the put option expires the worthless and incur loss of 285. The call option brings in profit of 200 rupees, 500 minus 300. When the loss from the put option is factored in, the trade occurs in the loss of 85. Bracket 200 minus 285 because the price was not enough to compensate for the cost of the option. The operative concept is move being big enough. If XYZ firm has raised 10 rupees in share price to 60, the total gain would be again 415 rupees, 1000 minus 300 for the call option premium minus 285 for an expire. So friend, this is a long straddle strategy and try to understand. This is really profitable strategy. Please subscribe video in case you have not subscribed and press the bell icon and share to your friends for learning long straddle option strategies. Friends, option you must do a lot of practice, you must do prepare trade, you must try to understand and go detail in deep and try to go through videos one by one so you will able to understand. I have already covered implied volatility, basic payoffs for the option and basic terminology in options, so you will able to correlate all if you go one by one. This video is for your learning purposes. Try to learn more and more. Thank you friend. Good night.